Welcome to the deep dive. Today we're looking at Jamaica, a place many, picture as pure paradise.
Beaches, music, tourism.
Exactly. But we're digging deeper into its housing market outlook for 2026. And what the sources are showing us is, well, it's a story of local strength really being tested by global instability.
Right. It's fascinating because things happening thousands of miles away are suddenly shaping the value of, say, a villa in Ocho Rios.
So the big question we're tackling is, can the market hold its ground, or is some kind of reckoning on the way?
And that's the real tension here, because if you just look at Jamaica's internal numbers, things look pretty decent.
Yeah, like what?
Well, inflation's within the Bank of Jamaica's target. Unemployment's at record lows. The BOJ policy rate, that's been steady at 5.75% since mid-2025. So the local picture seems sound.
There's always a but.
But the market's fate is really tied to these tremors from far away. Global trade issues, energy prices, even, political shifts. We found this quote from an analyst that just nails it. A house is never just bricks and mortar. It's a bet that the world around you will stay stable.
Wow. Okay, that sets the stage. So our mission today for you listening is to connect those dots. How do these distant global tremors actually impact construction costs, home prices, affordability right there in Kingston or Mobay?
Exactly. Let's unpack that.
Okay, let's start with that local foundation. You said it looks robust, and a big part of that is the National Housing Trust, the NHT, right?
Absolutely. The NHT has been crucial. They've expanded loan limits to help counter rising construction costs, and they offer these heavily subsidized loans, sometimes like 0 to 5% rates, for lower and middle income folks. That's a significant buffer.
It definitely sounds strong, a real safety net.
It is strong, yeah. But, a buffer only works up to a point. Jamaica is still a small, open economy, and it's incredibly dependent on outside factors. There are basically two huge pillars holding things up.
Okay, what are they?
First, remittances. Money sent home by Jamaicans abroad, mostly from the U.S. and U.K. That accounts for, get this, roughly 20% of the entire GDP.
20%. Just from remittances, that's massive.
Huge. And the second pillar, tourism. That's another 30% of GDP and employs over 300,000 people.
Okay, wait. So 20% remittances, 30% tourism. You're saying half the country's economic output relies on things happening outside Jamaica.
Precisely. 50% rests on external conditions being favorable. And when you look closer at where that support comes from, well, you see the American connection.
The U.S. influence.
It's really outsized. The U.S. takes about 40% of Jamaica's exports, sends 60% of its tourists, and crucially is the source of nearly 3/4 of all those remittance inflows.
So if the U.S. economy sneezes,
Jamaica feels it immediately. If the U.S. consumer tightens their belt, that hits tourism and remittances. It's a direct channel.
which makes me question that word robust for the local foundation. I mean, if half your income depends on another country's economy, isn't that inherently fragile?
It's maybe better described as resilience within vulnerability. They have tools like the NHT, that's the resilience part. But the vulnerability to external shocks is undeniable. Economists have modeled this, even a modest 10% dip in remittances.
Which could easily happen if the U.S. slows down.
Right. That alone could knock as much as 2% off Jamaica's GDP. And that's not just a number on a spreadsheet. It means fewer people can afford rent, fewer can qualify for mortgages. That money from abroad, one source called it the invisible currency of Jamaican stability.
Invisible currency. I like that. If that currency loses value, the whole market feels it.
Instantly, especially demand.
Okay, let's shift gears a bit. What about the high-end market? The luxury condos in Kingston, those Ocho Rios villas we've seen booming, that felt very much driven by foreign investment, right? Diaspora money, the Airbnb market.
Absolutely. That whole segment was built on basically two things: confidence from global investors off to the diaspora, and readily available high-volume tourism to support rentals.
And both of those are looking shaky now.
They are. Global growth is definitely slowing. And maybe more importantly, airline costs are way up thanks to energy price volatility. That makes potential tourists and investors think twice. We're seeing the World Travel and Tourism Council actually trimming its Caribbean forecast for 2026.
And are we seeing symptoms of that already on the ground, in the market itself?
We are. Developers are reporting it's taking longer to sell new units, particularly those aimed at that investor market, sort of in the JMD $40 million to $80 million range.
How much longer?
The data suggests time on market has stretched by as much as 20% in some areas. That's a clear signal. The peak optimism, that sort of gold rush feeling, seems to be fading. Investors are getting more cautious.
Okay, so this leads to the idea of a selective correction, meaning the pain might be focused just on that high end.
That's the theory, yes. A flattening or maybe a modest price drop, say 5 to 10%, specifically in that luxury investor-driven segment. The idea is that the affordable end, supported by the NHT and local buyers, stays relatively protected.
But is that realistic? I mean, sentiment can be contagious. If the high end cools significantly, doesn't that make middle market buyers nervous too, even with NHT?
That's the big unknown. It's definitely a risk. The argument is for compartmentalization, that the drivers are different. But you're right, if headlines talk about falling prices, even if it's just at the top, it can dampen confidence across the board.
Let's talk about costs, the actual cost of building. We've seen how global issues can hit demand, but they also hit the supply side, right?
Mm.
Construction materials.
Oh, absolutely. And this isn't just abstract market forces. It's deeply political now. Take the renewed U.S.-China trade tensions.
Right, the tariffs, the restrictions.
It's bigger than just tariffs on specific goods. The sources are talking about economic fragmentation, this sort of splitting of the world into trade blocs. The IMF warns this could, long-term, shave up to 7% off global output.
7%. That's like erasing Japan's entire economy from the global map. That must have huge implications for development finance, for stability.
It really does. And for Jamaica, the impact is very direct, very tangible. Almost everything needed for construction is imported. Cement, rebar, steel, appliances, fixtures.
So if the global supply chain gets disrupted or politicized,
You pay more.
yeah.
Simple as that. Construction budgets blow out, pushing new homes further out of reach for ordinary Jamaicans, regardless of what the local economy is doing.
And layered on top of that, we still have the Ukraine war impacting energy prices.
That's the slow burn, the persistent drag. Volatile global oil prices feed straight into Jamaica's electricity bills, transport costs,
Yeah.
driving up local inflation, which in turn forces the Bank of Jamaica to keep interest rates relatively high.
Meaning mortgage rates stay elevated, squeezing that middle market even more.
Exactly. It dampens demand right where you need it most for broad-based growth.
Okay, now for maybe the most intriguing global factor mentioned, the Ibrahim Traoré effect. Explain this one. How does a young leader in Burkina Faso influence housing in the Caribbean? It feels like a stretch.
Yeah, it sounds abstract, I know. It's not about Traore the individual, really. It's about what his rise, and others like him, symbolizes. It signals this potential reshaping of the global order.
How so?
Well, these leaders are often actively looking beyond traditional Western partnerships, seeking closer ties, finance, maybe security arrangements with powers like China or Russia. It suggests a potential fragmentation of the Western-led development finance and aid structures that countries like Jamaica have historically relied on.
So, if those traditional relationships fray, or the global system becomes less predictable.
It impacts confidence. Jamaica depends on a certain level of global predictability, stable financial channels, transparent rules for aid and investment. When the world order itself seems to be shifting, getting maybe more polarized,
It creates uncertainty.
massive uncertainty. It makes international lenders more cautious, credit potentially harder to get or more expensive. Development finance might come with different strings attached. This general unease, this higher global risk premium, it eventually filters down, even to small economies, affecting borrowing costs for big projects, including housing.
Okay, that makes more sense. It's about the vibe, the global mood affecting risk appetite.
Precisely. The cost of global distrust, you should call it.
All right, let's try and pull these threads together. The sources seem to point towards three distinct tiers in the housing market for 2026. Can you break those down?
Sure. First, you have the affordable segment. This is really driven by the NHT, by local salaries. It's seen as the most resilient part of the market, mostly because of those subsidized rates.
Okay, tier one, affordable, NHT driven. What's next?
Tier 2 is the middle market. This is your typical end-user demand professionals, small business owners buying for themselves. It's driven by genuine need, but it's definitely vulnerable to job losses or, crucially, those remittance slowdowns we talked about. Very sensitive to U.S. economic health.
Got it. And the third tier, the flashy end.
That's the high-end investor market. That's where the foreign capital, the diaspora investment really lands. It's the most exposed. Hypersensitive to U.S. interest rates, tourism numbers, global risk sentiment. This is where analysts see the highest chance of that price correction, that potential 5 to 10% dip if things get tougher globally.
It is important, though, that the sources seem to agree this isn't likely to be a 2008-style crash.
But Jamaica's stronger financially now.
Yes, that's a key point. The consensus is that the improved macro framework, better fiscal discipline, the BOJ's inflation-targeting stronger financial regulation provides a significant cushion against a full-blown meltdown.
Okay, so no meltdown, but what are the likely scenarios analysts are mapping out for 2026? They lay out three main possibilities. The base case, the most likely at around 55% probability, is the plateau. Basically, the market finds its level. Growth stops, prices flatten out, things stabilize.
Okay, a plateau. Makes sense. Scenario 2.
That's the selective slide, given about a 30% chance. This is where remittances weaken noticeably, tourism takes a hit, and we see that high-end segment experience those price drops, maybe up to 10%. The rest of the market holds up better, but sentiment definitely cools.
And the third, the least likely but most worrying, the storm.
Right, that's the low probability, high impact scenario, maybe 15%. This is where several bad things happen at once. A significant global recession, maybe another spike in commodity prices, and a major climate event hitting Jamaica directly. We saw with Hurricanes Beryl and Raphael how quickly severe weather can become a major economic shock. That combination could lead to prolonged stagnation.
Wow. So multiple pressures converging.
Exactly.
There's another analyst quote that stuck with me. Not panic, just a deep inhalation before the next phase. It really captures that feeling, doesn't it? The market isn't falling apart, but it is adjusting, recalibrating to this new, more uncertain global reality.
That sums it up perfectly. It's the
Yeah.
core takeaway, I think. Jamaica has built resilience?
Yeah.
Absolutely. But resilience isn't the same as immunity. The real test now is whether the country can absorb multiple external shocks, economic, geopolitical, even climatic hitting potentially all at once, without its financial structure buckling.
Which brings us back to that powerful final image from the sources. We have to build as if the world will sometimes be cruel and make sure our structures, both financial and physical, can stand up when it is.
A strong closing thought. And building on that, we talked a lot about external factors, remittances, tourism, global finance. But the sources also flag climate events as this potential fourth domino. So a final thought for you, the listener, to ponder. If that external confidence, the money flows from tourism and remittances, falters at the same time as Jamaica gets hit by severe hurricane or drought, which local safety net gets tested first? Is it the NHT? Is it the private insurance sector? Or does it fall back onto government policy to prevent a really deep economic slump? Which pillar needs to be strongest when the storm truly hits?